Afternoon, everybody. I'm Singa from Vunani Private Clients. I sit at the trading desk. Today, we're just taking you through to the basics of investing, really, which is just an introductory presentation on what is investing and how you can get started. So going forward to the next slide, we'll look at what our contents are. We'll first start with the basics of really what the basics are, which is what is the stock market, types of investment products, how to trade shares, the benefits of investing, are you a trader or are you an investor, and what do you need to get started. The basics here really are that when you are participating in the stock market, you are then looking to start investing. You do so by buying shares of these companies that you see here. I've put a few brands that you will probably recognize, like your Sasol, MTN, Anglo-American, PPC Cement, etc. You as a buyer becomes part owner, or what we call a shareholder of a business, when you buy shares which are commonly known as common stock. You are therefore buying equity in businesses. As a shareholder, when you've bought equity in a business, you then become a shareholder. Shareholders have the right to vote and receive dividends as well as subscription privileges. That is what you get in return by buying a share or common stock of a company. You are really investing in management, in profits, and ultimately the assets of the company. So when you look at a company that you think has got a great future, you think that their assets will grow. Therefore, your investment in that company would grow with that growth. So how do stock trades? The purpose here, the purpose of stock market is to facilitate the exchange of securities between buyers and sellers, reduce the risk of investing. Just imagine how difficult it would be to sell shares if you had to call around the whole neighborhood trying to find a buyer. So what a stock market do for you is to bring together a buyer and the seller. So that is one of the functions that the JSE undertakes in the South African context, in our market. So how you should really look at stock market is really what the picture here shows you. It's like any other market, like a vegetable market, where people will sell different types of veggies. Sellers will meet buyers, and the prices will be discovered as they exchange money for goods. That's what a stock market is all about, but in a computerized, sophisticated manner. But in reality, what a stock market is the same as what you see here in this picture, a vegetable market. Still on the basics, the stock market can be split into two main sections, the primary market and the secondary market. What the primary market is, it is a market where new issues, which is new shares that are being sold for the first time, are conducted. So when a company comes to the JSE and they want their shares to be sold to the public, they are taking a process that is called initial public offering, an IPO. That is the market for shares that are going public for the first time. That is what we call primary market. Secondly, we then have a secondary market where all subsequent trading goes in that market. Participants that are involved in that market will be individuals and would also be institutions. Most of you who have a little bit of familiarity with investing, who perhaps have bought an investment product at some point in their lives, you would then have participated in the secondary market. Like I had mentioned in the previous slide, secondary market is a market in which existing securities or shares are traded. One other thing that you need to also keep in mind when we talk about the secondary market is that the prices of shares or securities, by the way, A share or a security on equity is one thing. It's just different words which are interchangeable. You will find that a lot when you are approaching investing in the market. Prices of shares in the secondary market are determined by market participants, which is a buyer and a seller, through demand and supply principle. Just to go a little further on the demand and supply principle, which helps in the price discovery. Stock prices change every day as a result of market forces. Market forces being the guys who are buying, the demand side, and the guys who are selling, the supply side. So by this, we mean that share prices changes because of supply and demand. If more people want to buy a stock, then demand is up, then people who wants to sell it, supply, the price will move up. Conversely, if more people want to sell a share than buy it, then the price would go down. It's the same thing as in the vegetable market, where if there's more people selling tomatoes, the price of tomatoes will come down because there's hell of a lot of supply for it. But when there's very few people who are selling tomatoes and there are a lot of people who wants to buy those tomatoes, the price of each tomato that is being sold in that market will go up. That's the principle that moves share prices in the stock market. And just a little bit of trivia for you. What we call truth is that nobody really knows for sure. Some people believe that it is impossible to predict how stock prices will change, while others think that by drawing charts or looking at price movement, they will be able to determine what a share should be selling at. But in actual fact, no one really can truly determine what a price will be, other than the forces which dictate the market, like supply and demand. So if you understand that point, you're halfway understanding what the investment world is about. Type of asset classes. Asset classes are the products that you can buy when you invest in the market. We call them asset classes. And in simplicity, it's already information that you are aware of, maybe consciously or not consciously. The first type of asset class that is very popular in the stock market is equities. Another name for equities is shares, as I mentioned in the previous slide, shares or stock or security. Those are equities, those are pieces of companies that you can buy, that you will own, and you will be receiving a dividend on it, or capital appreciation, or you'll get voting rights, you'll get privileges of owning that piece of company in the form of shares. Second asset class that is also mostly traded in the stock markets is bonds, are fixed interest instruments. For an example, when government is looking to raise debt, they would use government bonds to borrow money. And if you as an investor borrows government money, they will pay you an interest either annually or semi-annually. So you will be receiving a fixed interest income on borrowing money to the government through a government bond instrument. Another asset class that is also very popular within the market is properties. We will mostly be talking or dealing with listed property. That's the property those are property companies that are participating either in the commercial property, like for example, shopping complexes, or industrial properties, for example, warehouses, or residential campus properties, for example, estates and complexes that people live in. You can invest in listed property through the market. Another asset class is commodities. In simplicity, commodities are well traded all over the world. They are one of the first instruments to be traded in the market. For example, In the market, you can find price of gold on a daily basis, price of silver, price of corn, price of platinum. That asset class is a highly, highly traded asset class. You can get access to it if you invest in the stock market. And another type of asset class is cash. Cash that sits in the bank that perhaps all of you would know. Now let's look at different types of investment products. You have long-term investment products. If you are looking to put money away for the long term, there are a couple of products that you can put in money into, but I'm just gonna, for the purposes of this presentation, because it's an introductory presentation, I just picked out the two most popular long-term investment products, which is collective investment schemes. For example, they are also called unit trusts. There are lots of financial services companies that will sell you a unit trust. It's a long-term investment product. It really is a basket of shares that will be housed into one product, and you buy one product and you have access to the shares that are in that unit trust. Another investment product that is quite long term is retirement annuities. These are saving schemes for your retirement. When you get to the retirement age, at least you have some money that you have been saving, and that money throughout the time is being invested in the stock market. Also, if you are interested in short-term trading products where you are looking to take advantage of short-term movements in the market, maybe on a daily or weekly or monthly basis, or less than a year basis, then you are looking at cash equities. I've mentioned what equities are. Those are shares. Or you can look into more riskier and sophisticated products in the form of derivatives. There are plenty of derivative instruments, but for the purpose of this presentation, we will not go into detail for them, but I've put in a few that people might recognize, like single stock futures, CFDs, options, and warrants. Also, on the short-term space, you can also trade Forex, which is currencies, taking a bet on one currency versus the other. So in my example here, I'm saying if you think that the US dollar is going to be stronger than the rand in the next coming month, you can trade a currency by buying a US dollar versus the rand. So I think what most of you would have logged into this webinar for is to really understand the benefits of investing in the market. And here are the few benefits that I've put. I've tried to go very basic for the purposes of people who are new in the world of investing. The market provides a safe environment to buy and sell equities and derivatives and any other product that you can be able to access in a financial service institution. The dynamic nature of the market can offer substantial profits because how does that happen? It happens in this way. If you buy a share of a company today on the 29th of September 2014 and you then sell that share of that company in 10 years' time, on the 29th of September 2024, if that company has grown over the 10-year period, your investment will also grow with that company. That's how you can make money in the stock market. And we've seen how a lot of South African companies have started really small, like my earlier example of MTN. MTN came into the market in 1994 at 20 bucks. It's now trading at 240 bucks 20 years later. You would have made money in that company if you had invested then. Another benefit of being in the market is the fact that it gives you flexibility depending on your risk appetite. There are a number of instruments that you can invest in. You have a very, very wide choice. And you have brokerage firms that provide easy access to the market through getting you started, from getting an application form completed to giving you advice on how you should spend your savings in trying to build an investment. So really, when you're participating in the market, buying and selling stock is like running your own business. It's like running your own little spaza shop where you are selling different veggies to different buyers and sellers. So you then would need to, before you think about going into the stock market, you need to have a few questions answered in your mind. For example, you need to first determine if you are an investor who is focused on drawing the money over the long term, who is willing to be patient and wait for growth to take place. Or are you a trader, somebody who's looking to take advantage of the market in the short term? By doing so, you're assuming a certain level of market risk, which is when a price doesn't go your way. So you must always determine which type of person you are and what type of risk you can assume when you start approaching investing. So let's first look at an investor. What an investor is. Typically, somebody that would open an equity account, which is a portfolio of shares, buying shares over time, hoping for the long-term growth, and you do not participate in the daily moves of share prices, and you have a low tolerance for risk. If you are that kind of person, then you're an investor. You're looking for long-term risk. You're willing to wait for growth over the long term. So it's like planting a tree. You know that it will not grow immediately or in 3 months' time. Sometimes the leaves might look a little bit patchy, not green and bright, but over time the tree grows to be big and strong, and the leaves start looking pretty shiny. If you're a trader, you are typically someone who's looking to take risk in the stock market. You are looking more perhaps in derivative instruments because they give you a gearing. So if you look at our visual here, our exhibition, you see that this guy is about to shoot into the sky. It's because of this instrument behind him that will give him that boost to go up really fast. That's what derivative products do. They gear you up for strong growth, but there is much bigger risk in trading derivatives, because as fast as you can go up, it is as fast as you can go down. So what do you need? Do you need a broker to start investing or trading in the stock market? Yes, you do need a broker. Stockbroking firms are members of the stock exchange, which is, in our case in South Africa, is the Johannesburg Stock Exchange, located in Sandton. It is therefore possible as a private individual to trade directly on the stock exchange through a stockbroker. So what you need to make contact with a stockbroker that you've made contact with, that you think you can trust, and open your account, either being an investment account or a trading account, and you get going. So essentially, what you need to get started is really to complete maybe an investment mandate with a stockbroker, be able to provide them with your identification in terms of our financial advisory and intermediary services act, that requires you to have your proof of ID, documentation, proof of banking account, proof of tax, proof of address, which is what FICA is all about. Once you have those details with you, you've already contacted your broker, then you can then send them through all of those documents, have the account opened for you. Once that is done, you can then start funding your account, whichever one it is, and then you are on your way to start investing. Thank you for attending. If you've got questions with regards to how to get started or you need more information about investing or trading, feel free to contact us. You can email us at tradingdesk@Vunani Private Clients, or you can give us a call on 011-384-2920.